Good day to everyone who is into self-improvement. Today we're talking about own working capital, a concept that many entrepreneurs stumble upon after reinventing the wheel. The explanation, as always, will be in simple words and with a clear example. As a bonus, I'll show you how to calculate management profit using an indirect method without breaking down income and expenses. Plus, we'll see how business owners arrive at the same conclusion, though they tend to take the scenic route. Let's go. When there's money, business runs. At some point, the owner starts wondering, how much of the money flowing through my business is actually mine? How much have I really earned over time, or at least in the past year? After all, I calculate profit mainly based on cash and bank balances. But what about debts? On the other hand, I have a warehouse full of stock, which is also future money. And this is where the inevitable introduction to finance begins. Let's take an example, say, a business selling spare parts for tractors. Imagine we have a small spare parts store. We purchase goods from suppliers, sell them to farmers and service centers, and keep a certain stock in our warehouse so that customers can simply come in and pick up what they need. Some parts have to be ordered with prepayment, then suppliers deliver them, while others are taken on credit with deferred payment. In addition, we have a bank loan that is not yet fully repaid. Thus, the amount of money in the account and in the cash register does not fully reflect the real situation. The business owner, let's call him John, wants to figure out how much money he is actually making, how much of the money circulating in his business really belongs to him and won't have to be paid back to suppliers or the bank later. Business generates income, but the account balance does not consist only of his own money, as part of it consists of advances from clients, debts to suppliers, and loans. So simply looking at the bank balance is a dead-end approach. The business owner then comes to a logical conclusion. If he calculates everything he owns and subtracts all his obligations, what remains is the real amount that belongs to him. Sooner or later, all entrepreneurs come to the same conclusion, even if they are far from finance. This indicator has many names: reserve, free balance, my capital. The variety is limited only by the imagination of business owners. But in financial terms, it's called own working capital. It was introduced more than 100 years ago. Let's assume that we have management accounting in place and it is maintained properly. To understand the idea, let's first look at the structure of the management balance sheet, a report that shows what exactly our business consists of. Assets are everything we own. You can learn more about this in my video, What Are Assets and Liabilities? In this case, they consist of cash, inventory, accounts receivable, and money that clients owe us. Liabilities are the sources of business financing. Here we have loans and borrowings, debts to suppliers, and owner's equity. What actually belongs to the business owner? Now we can move on to the most important thing, the formula for calculating own working capital. This is the difference between current assets and short-term liabilities of the company. Current assets include cash, inventory, and accounts receivable. Short-term liabilities include our loans, debts to suppliers, and client advances. Let's calculate using our example. Suppose John's business has $15,000 worth of inventory, $5,000 in the bank, customers owe him $3,000, and he himself owes suppliers $12,000. We calculate own working capital. $15,000 plus $5,000 plus $3,000 minus $12,000, which gives us the difference between $23,000 in assets and $12,000 in liabilities, totaling $11,000. John concludes that $11,000 is truly his money. Unfortunately, this calculation is not entirely correct, although it gives an approximate understanding of the situation. Let's discuss this. Usually, when making such calculations, entrepreneurs forget about payroll and taxes. Here's the catch. The timing of these payments and the period in which they were accrued don't match. That is, part of the payroll you pay in March is actually wages for employees who work in February. It's the same story with taxes. In fact, we are dealing with liabilities that we forgot about, and they must be reflected in the management balance sheet. Without this, we'd be looking at the situation through rose-colored glasses. Let's refine the calculation. Let's say $3,000 is still needed for payroll. The employees have already earned it, but we will pay it later. That means it's our liability. And for taxes, let's assume $500. Now, the adjusted amount is already $7,500. Quite a shift in perception, right? Now let's look at another very important application of own working capital. Suppose we calculated this figure at the end of the month, 7,500 as we remember, and now let's do the same calculation for the beginning of the month. Suppose the resulting value is $5,500. What does this mean? Where did the difference come from? And here we arrive at a very interesting property of own working capital, which serves as a way to verify the accuracy of management reporting. This time, let's refer to the full management balance sheet, which also includes fixed assets, for a complete understanding. As we can see, changes in the amount of own working capital can be caused by earning profit or losses, investing in or acquiring fixed assets, selling fixed assets, or withdrawing investments, obtaining a long-term loan. In fact, there are many other factors, but we have a small business and we're discussing the basic principle of this indicator. So let's return to our example. John remembers that he bought a new desk for $150 for his employees, but made no other unusual transactions. So we conclude that over the past month, he earned $7,000 divided by 150 minus $5,500 for $850. In this case, the $150 is profit usage, meaning his actual net earnings were higher, but we invested this $150 in fixed assets. If you noticed, we didn't perform any complex economic calculations or prepare a profit and loss statement for the past period. Nevertheless, with this simple method, we can determine the profit of a business for a selected period of time. Of course, this only works if you properly maintain the rest of your management accounting. So let's sum it up. Own working capital is the money that belongs to the business owner and is independent of debts and liabilities. It shows how stable the business is and whether it can finance its operations without borrowed funds, or rather, how much it can do so. If own working capital is positive, it means the business has its own resources and is partly operating with its own money. If own working capital is negative, it means the business is entirely running on borrowed funds and is walking a financial tightrope. This is not always bad, but it does mean the business is financially unstable. Now, John understands that even if he has $5,000 in his account, not all of that money is freely available for spending. He first needs to calculate own working capital, and he can only spend what belongs to him. That is, if he wants to maintain financial stability. I hope this explanation made it clearer why calculating own working capital is important and how it's done, and also how to determine how much the business has earned or lost in the past period without calculating profit and loss. Subscribe to my channel, hit the like button, and I hope to bring you many more useful videos that will help you in real life.